Good day, ma'am. Good day, everyone. We are the presenter of Chapter 4, and our topic is all about financial intermediaries. So, what is financial intermediaries? Financial intermediary is like a middleman in money matters. Ang middleman ay isang tao o negosyo na nagsisilbing tulay o tagapamagitan sa isang transaksyong pangnegosyo o pangpinansyal o isang supply chain. Kagaya ng mga broker, ahente, distributor at wholesaler ay mga halimbawa ng middleman. Pinagdudugtong nito ang mga tao o kumpanya na may sobrang pera o tinatawag na lenders sa mga tao o kumpanya na nangangailangan ng pera o tinatawag na borrowers. Kung wala ang mga institusyong ito, magiging magulo at hindi epektibo ang paglipat ng kapital at ito ay malilimitahan lamang sa direktang transaksyon between parties. How it works? Lenders or the cash surplus is ito ay mga individual o kumpanya na may sobrang pera na hindi pa nila kailangan sa kasalukuyan. Example is isang tao na nag-iipon ng pera sa bangko. Tapos yung financial intermediary naman is this is the middleman or kagaya ng mga bank, investment fund, mutual fund, or pension fund. Kinukuha nito ang sobrang pera mula sa mga lenders at ibinibigay naman ito sa mga borrowers. Sa borrowers naman, o cash deficit, is ito ay mga individual o negosyo na nangangailangan ng pera para gastusin, ipamuhunan, o palaguin ang kanilang negosyo. Example is isang kumpanya na umutang upang mapalawak ang kanyang negosyo. So let's move on to direct and indirect finance. Let us first define what is direct finance. Direct finance. Borrowers get money directly from lenders or no middleman. Karaniwang ginagawa sa pamamagitan ng pagbibenta ng stocks o bonds. Ang halimbawa nito ay isang kumpanya ang direktang nagbibenta ng shares sa mga mamumuhunan. Another example is yung government ay direktang nagbibenta ng bonds sa publiko. Yung key points niya dito is money flows straight from saver to borrower. While indirect finance naman is ang mga borrowers ay nakakakuha ng pera sa pamamagitan ng financial intermediaries tulad ng bangko, credit unions, mutual funds, and then savers deposit money, intermediaries collect it, then lend it to borrowers. Example is bank loans, mortgages, credit cards. Yung key points naman niya dito is money goes through a middleman before reaching the borrower.
Good day everyone, I am the second presenter and I am Gabilan Riam Sista, and my topic is all about the changing nature of financial intermediaries. So here to explain how financial intermediaries like banks have changed over time. In the past, banks relied mainly on physical branches and face-to-face interactions. But today, due to technology, deregulation, and globalization, the system has become more digital, interconnected, and technology-driven, moving away from that traditional model. And now let's move on to the key aspects of financial intermediaries. So we have heard of 5 key aspects. So the first one is rise of technology or fintech. Digital tools like online banking, mobile payments, AI, and blockchain are transforming financial services. So dito, mas ginagawa nilang mas mabilis, mas mura, at mas mahusay ang mga transaksyon habang nagpapakilala ng mga bagong kakumpetensya gaya ng mga fintech, startup, and cryptocurrency. And the second one is disintermediation and reintermediation. So dito, mas binibigyan daan ng teknolohiya ang mga borrower at nagpapahiram ng direktang komunikta, for example, peer-to-peer lending, na binabawasan ang papel ng mga traditional na tagapamagitan. But at the same time, new fintech platforms act as intermediaries but in more specialized and efficient ways like robo-advisors. And the third one is shift in relationships. Traditional banking relied on personal, long-term relationship. Ngayon naman ay pinapalitan ng data, algorithm, and standardized na informasyon ang mga pakikipag-ugnayan ng harapan. And the fourth one is blurring boundaries. So different types of financial institutions like banks, insurers, investment firms now offer overlapping services and creating financial conglomerates. And the last one is growth of shadow banking. Non-bank institutions play a larger role in financial intermediation, often with less regulation. While this can increase efficiency, it also poses risk to financial stability. And now let's move on to the classification of financial intermediaries, or the different ways we can group institutions that connect savers and borrowers in the economy. Financial intermediaries play a key role in channeling funds, managing risk, and supporting economic growth, and they can be classified in several ways. So the first one is based on functions. So we have here depository institutions and non-depository institutions. The depository institutions like commercial banks, savings banks, credit unions, nag-a-accept sila dito ng deposits and they provide loans. While non-depository institutions like insurance companies, pension funds, mutual funds, they invest and manage money without taking deposits. And the second one is based on structure. So here it includes investment banks, brokerage firms, and and asset management companies. And the third one is based on transactions. So we have a primary market and secondary market. Primary market intermediaries handle new securities, for example, underwriting. While secondary market intermediaries, they facilitate buying and selling existing securities, for example, brokers and dealers. So the fourth one is based on regulations. So we have a regulated and unregulated intermediaries. So regulated intermediaries like banks, insurance firms follow strict oversight, while unregulated intermediaries like hedge funds operate with fewer restrictions. And the fifth one is based on instruments used. So we have here equity intermediaries and debt intermediaries. So the equity intermediaries deal with stocks and shares, while debt intermediaries it handle bonds and similar instruments. And the last one is other types, peer-to-peer lenders and microfinance institutions which expand access to credit.
Good afternoon, ma'am. Good afternoon, everyone. My name is Bola Wisenrus. Today, I will discuss the depository institution and non-depository institution. A depository institution is a financial organization where people, business, and deposit their money. Safekeeping in this institution use this deposit to provide loans and other financial services. There are the types of depository institution. First is commercial bank. Commercial banks is a type of depository institution that accepts money from the public and provides loans and individual business and even the government. The second is credit union. Credit union is a member-owned financial institution that provides many of the same service as bank, like saving accounts, loans, and payment service, but one difference. Instead for being non-profit is now run for benefits of its member. And the last is savings institution. Savings institution is also called savings and loans association or TIF institution. The types of institution that focus mainly on helping people save money and borrow from the ownership. Non-depository institution is a financial institution that does not accept deposit from the public. Unlike banks or savings institution, people can open a saving or checking account with them instead to nagpo-provide sila ng lending money, investing funds, offering insurance. There are the types of non-depository institution. First is insurance companies. Sila yung nagpo-provide ng life and health property insurance. And the second is financial companies. Sila yung nag-o-offer ng personal loans, car loans, or appliance installments plan. The third is pension funds. Sila yung nagmamanage ng retirement savings for employees. And the last is securities firm that help investors trade and manage investment in stock, bonds, and other securities. Today, I will discuss the financial risk intermediation. Financial intermediation or in financial intermediaries like banks, insurance companies, fire several risks as they act as a link between savers and borrowers. The main risks include: first is credit risks. The risks that borrowers will not pay back their loans. Nagpautang ang isang bangko ng 1 million sa isang negosyo ngunit nalugi ito at hindi nakapagbayad. The second is liquidity risks. Panganib na mawalan ng sapat na cash at institution para sa biglaang ng withdrawal ng mga deposition. Market risks. Panganib na pagkalugi dahil sa pagbaba ng halaga ng securities o investment. Operational risks, panganib na pagkalugi dahil sa internal na problema tulad ng pandaraya, pagkasira ng system o pagkakamali ng ito. Solvency risks, a company or individual will not enable to meet its financial obligation as they come to. And the last is sovereign risks, is the foreign government will difficult on it debt or fail to meet its financial obligation.
And my name is Bola Biancaros. So we will discuss about the role of financial intermediaries in socio-economic development. Financial intermediaries play a crucial role in socio-economic development by facilitating the flow of funds between savers and borrowers, not promoting financial stability and supporting economic growth. Here are some key of role financial intermediaries. First is mobilizing savings. Financial intermediaries encourage savings by offering various financial products and services. For example is yung bank. Nag-offer sila ng savings account at flex deposit kung saan pwede mag-ipon ang mga tao. Din yung pira na naipon doon gagamitin ni bangko para magpautang sa mga businesses na gustong mag-expand. Second is channeling funds to investment. They allocate financial resources to various sectors by assessing the risk and return of financial investment. For example is yung pension funds. Nangungulikta ng contribution mula sa mga worker and ina-invest sa mga infrastructure project tulad ng road at power plants. The third is reducing information asymmetry. Financial intermediaries such as bank and investment firm reduce the information gap between savers and borrowers. For example is yung investment bank. Nag-analyze ng companies bago sila maglabas ng bonds or stock sa public. Fourth is risk management. They are provide financial products such as insurance and diversified investment option, allowing individual and businesses to manage risks effectively. For example, ito yung insurance companies. Nag-offer sila ng life or property insurance para matulungan ang mga tao at negosyo ng ma-manage ang financial process kapag may aksidente or disaster. 5 is facilitating transaction. By providing payment system and platform, financial intermediaries makes it easier for individual and businesses to product transaction, reduce costs, and increases efficiency in the economy. 6 is promoting financial inclusion. They play a critical role in expanding financial services to underserved populations such as low-income households and small businesses. For example is yung microfinance institution. Nagbibigay sila ng maliit na loans sa low-income families or maliit na businesses owners sa rural areas na walang access o traditional banking. 7 is supporting for government policies. Financial intermediaries can facilitate the implementation of government fiscal policies by managing public debt and financial development projects through contribution to macroeconomic stability. For example is ang central bank or commercial bank. Tumutulong ito sa gobyerno na magbenta ng treasury bonds para makalikom ng pundo na gagamitin sa public infrastructure project like the school and hospital. So, number 8, economic growth and employment. By providing the necessity financing for businesses, especially small and medium enterprise, financing intermediaries help create jobs and generate income, leading to overall economic growth. For example is yung isang bank nagpapautang sa na mas mababa na halaga, gaya ng local restaurant o manufacturing shop. Dahil dyan, nakakapag-expand sila at nakaka-hire sila ng mas maraming worker at nakakatulong sa local economy kaya tinatawag na natin na economic growth at employment. The last is the innovation and development. They are also encourage innovation through venture capital and private equity financing, which nurture startup and new project that drive technological advancement and encourage progress. For example, is yung venture capital frame. Dahil dyan, nagpa-found ng startup gaya ng teach companies para makapag-develop ng bagong product like apps or technologies na nakakatulong sa economic progress. So we will proceed to the economic basics for financial intermediation. Financial intermediaries exist due to several economic reasons, including the needs for liquidity, risk sharing, and information asymmetry. The economic basics for financial intermediation stem from the existence of market inflation that creates significant costs and obstacles for directly connecting individual, savers, and borrowers. There are the four economic and market addresses by financial intermediaries. First is reduction of transaction costs. Sa financial intermediaries like banks, cooperatives, pawn shop, tumutulong para bumaba ang gastos at hassle sa pagpapahiram ng pera. So, meron tayong dalawang cost of reduction. First is searching cost. Kung ikaw ay borrowers, mahirap maghanap ng taong willing magpautang ng malaking halaga. Kung ikaw naman ay savers, mahirap din maghanap ng taong honest at may magandang negosyo para pautangin. Second is negotiation and monitoring costs. Kung direct ka magpapahiram ng pera sa isang tao, kailangan gumawa kayo ng kontrata o usapan sa internet at siguraduhin na magbabayad. Second is negotiation of asymmetric information. Asymmetric information, ibig sabihin ay hindi pantay ang knowledge ng borrowers at lender. Kasi ang borrowers ay mas alam niya ang tunay na financial status at intensyon niya. Ang lenders naman ay limitado lang ang alam kaya pwede malugi o maloko. Dito na pumapasok ang financial intermediaries like banks, cooperatives, microfinance, insurance companies para maging middleman at ayusin ang imbalance ng info. The third is risk sharing and diversification. Intermediaries help savers manage risks more effectively than they are could on their own, allowing for greater investment in productive but risk enterprises. For example is, kung in-invest mo ang 50,000 sa isang small business at bumagsak ito, ubos lahat. Pero kung ilagay mo ang 50,000 mo sa mutual funds, hahatiin ito ng 100 companies kahit may ilang malulugi. Nababalanse pa rin ang mga kumikita kaya hindi ka malulugi ng buo. The fourth is maturity and liquidity transformation. Financial intermediaries perform maturity and liquidity transformation by taking short-term liquid deposit from savers and lenders, then out of long-term loans to borrowers. So, for example, is nag-deposit ka ng 20,000 sa BDO savings account, tapos si BDO gagamitin nila yung part ng pera na yun para magbigay ng 10 years housing loans sa ibang customer habang nag-iwan pa rin ng sapat na cash para sa possible mong withdrawal.